All right, guys, welcome to Module 4, the tech one. Setting up your charts. Again, we kind of started this in Module 3, but these tech ones are kind of a little bit of a combination of tech and foundational. So we're going to start getting practical here, a little more practical. One of the things you want to think about when you go into a trade is what is your assumption or your thoughts about the way a stock is going to go. Now, I said the beginning of this course that nobody knows which way a stock is going to go. And that's true. It's essentially a 50-50 bet. Okay. Now we know, based on earlier weeks, that markets in general, the general overall stock market, goes up about 53% of the time. So we do know that in general, like if we were to work with something like SPY, the S&P 500, we know in general that it tends to weight towards going up in general, but that's over like a 100-year period. On any given day, just remember that we're going to make some assumptions here on upwards, downwards, and range bound, but you can be as right as wrong. And in actuality, in some cases, it doesn't really matter which one you choose. Because remember, when you're selling options, you don't have to be right. You just have to not be wrong. And we're also going to look at ways that you can manage losing trades to give you more time to be right as time goes by. But I'm going to give you some general rules of thumb because this is the number one question that I get is how do you pick which way a stock's going to go? Because we want to pick a direction and then we can choose a strategy based on that, right? Selling a put is bullish. Selling a strangle is neutral. Well, how do we decide? Well, that's what we're going to look at a little bit today. So the first thing you're going to want to do is if you're in Thinkorswim, if you go to your charts, just make sure your charts are set up correctly. You should have set this up already in an earlier module, but just to make sure, I'm in my paper trading account here and it's not set up correctly. So let me pause and let me switch to a correctly set up account. No point in wasting your time with this. Back. So I've got number one, I've got my correlation chart. I've got my implied volatility chart. And if I were to choose a stock here, let's go with, say, IBM. I've got my corporate actions on, which would be any kind of earnings announcements and if there's a dividend that is part of the stock too. Okay, so here's what we're going to look at. First of all, price movement. Now, you're going to find your own style here. I'm going to tell you what I look at. There are essentially two things that I look at. Number one, big price movement in one direction or another. And number two, general range boundness. So for example, look at IBM right now. It's sort of in a range, okay? It's not really been doing anything. But at the same time, it's way up top for where it's been over the last year. So if I were to look at IBM, I'd say it's kind of range boundy, but at the same time, I think it's way up high. So I'd probably do something here as like a semi-neutral strategy. So I might say, okay, it's very high based on last year. So I might sell maybe a call a little closer to the stock price. Remember, call is bearish, so I want the stock price to go down. And I might sell a put a little further away, say down here. So I might do something like, say, the 40 delta call and maybe, the 40 delta call and maybe the 25 or the 30 delta put. In other words, I think it's high, but I think it's also range bound. So I'm going to sell both sides because I think it's range bound, but I have a sense that, it might turn around at some point. So I'm going to sell a put. I can be totally wrong on that, and I'm okay with that. If this stock continues to go up through my call, we'll look in later weeks about how we deal with that, okay? Remember, you're trading paper money now, so it's not a big deal. Let's take a look at something that is not correlated to the market. So TLT, let's take a look at TLT. What are your thoughts on TLT? Well, number one, it's very low, right? Number two, it's in a range, but it's quite a wide range. What would I do here? Honestly, you see this drop here? All of a sudden one day it dropped a bunch. That is the classic sign of when it's time to sell a put, okay? When there's a big drop. Now, some people might disagree with me and say, I'd sell a call up here too because it's kind of in this range. It's okay, whichever way you feel, okay? So that's direction. That's how I choose direction. It's literally, have there been any big price movements recently? So here I would have sold a put. Probably here I would have sold a put. Maybe somewhere, probably here, I would have sold a call, maybe, you know. Um, I mean, it literally, that is the depth of thought when it comes to these things. Um, Looking at general ranges and being what's called a contrarian, which means when a stock goes one way, you're going to play on it going the other way. So that's how I choose my directional assumptions. You may think of some of your own, but I would tell you one thing. If you start looking at like analysis and things like simple moving averages and Boolean variables and Fibonacci retracements, it's all bullshit, all of that stuff, okay? It's going to work sometimes and not others. The statistics show that it works essentially 50-50. You might as well toss a coin. So the only reason I go with assumptions is to be consistent. That way I know that if I have mistakes, I can look, well, this is the same thing I do every time, so it must be something about the strategies that I'm choosing or something like that. So that's how I make assumptions on price. It is as simple as that. It usually takes me about 5 seconds to decide which way I'm going to go on a stock. And I'll tell you, a lot of the time I do neutral, and then neutral, my second would be aggressive to the upside. When a stock goes down, I'll usually sell fairly aggressive puts. Aggressive meaning higher delta, so 30, 40, maybe even a 50 delta put. And then when stocks are on a real run up, I do very small downside trades, and we'll talk about that actually in module 5, because so far I've talked about selling a call, and I said that the amount of money you can lose on a call is technically infinite because a stock can go, you know, to infinity. Well, I'm going to talk about ways that we can limit our potential losses on those downside trades. You have to have downside trades, though, because you've got to trade everywhere. You're going to have a big cloud of trades for all the different movements in the market. So that's direction. Let's talk about implied volatility. So we want to look for volatility spikes and potential reasons why they occur. We're also going to look at volatility being what we'll call mean reverting. Okay, so we'll talk about that as we move along. So let's go into let's look at Tastyworks. Oops, charts in Tastyworks, SPY. Okay. Actually, you know what? Let's go Thinkorswim. It's a little more visual in Thinkorswim. So in Thinkorswim, we have a chart right here. This is TLT. Here's its correlation chart at the bottom. And you can see that, you know, it's pretty wavy, but in terms of correlation, this would be correlation to the market. The higher this number is, the more correlated it is to the market. It's kind of all over the place. There's a section here where it was pretty high, following what the market was doing. But I would say it's generally kind of all over the place. And if we look at its current correlation, minus 0.5, if you remember that a high number close to 1 or minus 1 means a strong correlation of a positive or negative. So it's not particularly correlated right now. Most of the time, TLT tends to be inversely correlated to the market. But, you know, right now it's kind of there, but not exactly. Let's look at implied volatility. So what's happening here is pretty solid, and then it spikes up, and then it drifts down, spike, drift down, spike, drift down. This is what we call a mean reverting property of implied volatility. Implied volatility will I mean, pretty much all the time is going to spike and then drift down over time. Sometimes spike, come right back down. As implied volatility increases, the price of options increases. So the price of the options in TLT were higher here, 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 to a certain extent here, than they were like right here. Okay. Now, depending on the instrument, TLT isn't the best example. Let me go to SPY. Take a look at that. If you look at my circles, they're sort of around the same places. But generally speaking, spikes in volatility in standard equities, which would be stocks, tend to correlate with big down movements. So as the price of the market goes down, the volatility tends to go up. So if we think of ourselves as being contrarians, price goes down, we sell a put. The beauty is that put's going to be very expensive. Put is also bullish. So in addition to the volatility coming down, if you remember, the price of an option, so we've got a put, is related to the price of the stock, the underlying, okay, the time till expiration, days till expiration, and the implied volatility of the stock. And this is just the underlying price, DT, and then IV. You'll hear me refer to this a little bit later. It's called Vega. So we've had Delta, Theta, and Vega so far. But the higher these numbers are, the more expensive the options are. And what that means is if I sell an option for $100, remember, if I sell something, I want it to come down in price so I can buy it back for less. And the price is affected by all of these things. So let's say on any given day, the Vega is, we'll just throw in a number. 10 is not a Vega number, but let's just say it is. Let's say on that same day, the stock price stays right where it is. No movement in the stock price. The days till expiration will not have moved because it's the same day. And the Vega goes down to 5. This option price might go down to, say, $75, which means I've just made $25. So here's what I'm getting at. We sell a put. It's bullish. It makes money when the stock price goes up. It will also make money when the Vega goes down. So if we look at this, price came down, the volatility came up, then the price bounced back up and the volatility went down. So we will make money at an aggressive rate when this happens. Stock comes down and it bounces. You're going to make money on the price of the movement of the stock going up. This is selling a put, and the volatility going down. Now the question is, how do we know it's going to bounce? We don't. We do not know if it's going to bounce, okay? But the beauty of selling a put is if the IV is high, you get more money. That means that your break even is wider. That means the stock can go further down because you've collected more money. So number one, we're sort of insuring ourselves anyway because the price gets higher, so we get a wider break even. Number two, if the stock doesn't go anywhere, we still make money on the put as long as it stays above the strike. So again, you don't have to be right when you sell an option. You just have to not be wrong. This is why selling puts, now we're looking at all strategies in this course, and I use all strategies, but I would argue that selling a put is the king of strategies. And it's for this reason. When stocks go down, the price of the puts tends to go up. When stocks go down, they go on sale. So people come in and they go, hey, let's buy, it's cheap. So you often get bounces when stocks come down in price. You don't always get bounces, but even if you don't, the expensive put means the stock can continue to come down. You still don't lose money. Or it can stay where it is and you make money. If it does go below the price of your put, then you can do a couple of things. We'll talk about rolling a little bit later, which allows you to give yourself more time to be right, or you can take ownership of the stock. Now, if you do this on a stock that you wouldn't mind owning anyway, there's no difference. If you'd have bought the stock here and it goes down, you would have lost money. So selling the put and losing money is better because you're going to lose less than if you bought the stock. Am I convincing you yet? Go out there and sell some puts, man. They're the best. Like, I mean, this literally is one of my go-to strategies is selling puts. So what we're looking for is spikes and implied volatility. How do we know what a spike is? We look at the range of volatility. So if we look at SPY, it's sort of generally in this range right here. And if you keep your eye on this number right here, implied volatility, keep your eye on that. As I move my mouse around here, it's what, 23, and there it's 13. So I mean, it goes a little lower than that actually. Here we've got what, 10, and here it's 25. So let's say it ranges between 10 and 25 over the last year. We know that when it's getting up into the 20s, it's high compared to itself. Doesn't mean it can't go higher. We just know in general it's higher than kind of where it has been. In Tastyworks, that is indicated to you by what's called the IV rank. If you look up here, IV rank. The higher that number is, the higher the implied volatility of that specific underline is compared to itself. And in your watch list in Tastyworks, make sure you have IV rank here. You can actually sort by IV rank. We're generally speaking going to be selling options in items that have higher implied volatilities. Now, we're just about time here, right? Yeah. So let me just check one last item here. Another reason that implied volatility can increase is because of earnings. So let's go back to IBM. That's IMB. I don't know what IMB is, but if you take a look at IBM, the earnings announcements, they're right here. Let me just draw some lines down. You see that? Look, almost all of IBM's implied volatility spikes are relating to earnings. We'll talk about specific types of trades you do for earnings a little bit later. You would expect this to happen, though, because it's uncertainty about the stock's price. But look at this. We also have a spike there before earnings. Let's take a look at, what's it? I don't know what Amazon's ticker is. Amazon. There it is. AMZN. Let's take a look at Amazon. And let's erase here. I know I'm a little over time, but this is worth, oh, that was not a very straight line. There's a little tick up there outside of earnings. You get the basic idea. Let's look at Macy's, because Macy's was a bitch to me recently. Here we go. Look at this drop here in Macy's. Big old drop. And look at that spike in implied volatility. That is a put selling situation right there. Now it carried on going down, but I don't know if any of you were following my trade, but if you remember what happened, what actually happened was I had sold, oh, I'm really going over time now, but let me go into this a little bit more detail. Oops. I had sold a put in Macy's about here, and I had sold a call about here. Then Macy's dropped. I lost a bunch of money on my put, but I made 100% on my call. So that first of all mitigated the amount of money that I'd lost. Then I sold a put and a call on that day because the volatility was so high. I sold both. I was just like, whatever. It might go back up, it might not. And what happened was I sold a put, then that put expired. I sold another put. I think I got to sign the stock in here somewhere. And I let the stock go back up through the price of my call, which meant I made 100% on these two puts. And then the stock got taken away from me when it went into beyond the price of that call. So right around here, I started making money on a trade that I was wrong on way up here. And it's because the volatility, the price of those options got so high that I was able to, I come out on top. As stocks go up in price, the volatility tends to go down. Keep that one in the back of your mind. We'll talk about it later. Next video.